Hello friends, my name is Ashok Sengupta from School of Management Sciences, Lucknow. I am working as an assistant professor. Today, we will start the topic merger and acquisition as a unit 5th in financial management and corporate finance subject in MBA program. So, why we need to understand this topic? Important is merger and acquisitions are a new way to handling the business nowadays. Due to the huge competitions, companies are merged, they are acquired by the bigger company because they are not able to sustain in the market. They are not able to sustain in the market because of the huge, because the increase in cost of capital, there because of the level of competition and rising in the cost of production, labor problems, raw material problems. Companies started working and then after some time they acquired by another company, merged by the other company. So, we in this topic today we understand about the concept of merger and acquisitions and also understand how we use the financial management constraint or how we use the financial management while doing the merger and acquisition, because there is a corporate finance having a good role in merger and acquisitions. So, the term merger and acquisition are often used as interchangeable, although they have slightly different meaning. Merger when two firms often to about same size agreed to come forward with a single new entity rather than separate operating. Both company stocks merge together and they become a new company. So, merger is like A company plus B company equals to C company. This is merger. This is actually merger where two companies merge together. We have a live example of, we have all mobile phone, we have the mobile phones, now it is a generation mobile phone and initially we have companies like Vodafone and Idea. Now they become VI. This is one of the biggest merger in India. Yes, it is in India only, because Vodafone is MNC and Idea is Indian company. But why they merge? Why they merge? They merge because they want to reduce the competition among themselves. They want to reduce the competition and want to become a big company by merge together to give the competition to compete with other giants in telephone sector like Airtel, Jio and BSNL. Therefore, they merge together, and by merging the employees of the companies are merged also. They are now the employee of VI, neither of Vodafone nor of Idea. Similarly, stock also changes. Stock also changes. Hence, merger is a kind of thing where two companies, three companies merge together and create a one entity. I have several examples also. let us understand first acquisitions. And acquisition happen when one company take over the another company, clearly establish itself as a new owner, and a purchase called acquisition. From a legal point of view, the target company ceases the exist, the buyer sell the business and the buyer continue to trade. Acquisition, acquire कर लेना, like Tata acquired Jaguars, Tata Steel acquired Cyrus Steel company. There are lots of Indian companies acquire the foreign companies. In acquisition, entity of one company like company A and company B, company A acquired by company B and its entity totally lost. There is no entity will remain of A, it totally merged with B, totally acquired by the B when a company take over the other. So, in business point of view, acquisitions and mergers are taking place to find out the new way of doing business in the market, find out the new way of doing in the business, because if you want to sustain in the market, you have to fight with each other. There is a cutthroat competition, Now, like company B want to establish its market, in South Africa, rather to go to initiate with new company establishment, acquisition of land, for legal formalities, and then competition in African local market. It is better to acquire a company which is working and operating in South Africa, So, when company going to market or establish its market operations without wasting the time of create a brand, create an entity, create legal things, it is better to acquire a company which is already exists in the market, like Nokia, Nokia acquired by Microsoft, then again to another company, Google. So, in India, if foreign company want to establish its market, ready-made market, they offer the price to the local companies, and if they ready, then they acquire the local companies. Sometime they because of the brand name, they will not change the name, they not change the name of that product or brand, but overall operations, management, control is by the new company. So, this is acquisition. So, driven by the globalization and strategic or economic barrier to internal growth, mergers and acquisitions are one of the principal way in which organizations can achieve rapid growth in the past. Organization can achieve rapid growth in the past. Mergers and acquisitions were focused primarily on gaining control of undervalued assets, which could then be either broken up or traded, known as asset strips or developed autonomous unit. So, overall concept is because of the globalization, we are connecting with each other. There is a network, there is a close network on which we are working, and because of global trade, because of the international associations, companies are looking forward to acquire the market to get benefit from different market, because they already have established themselves in their domestic market. Now, they want to earn more, to sustain, they want to get more and more profit to maintain their shareholders. To earn the more and more profit, they need to sell their products and services, and for that companies looking forward for the basic strategies like mergers, acquisitions. Today, the typical merger acquisition is more strategic or operational in its intent, whether an emphasis on achieving industrial consolidation or access to new market. So, it is a need of today, to sustain and give the growth. If we are sustained today, and give the growth to our wealth of the shareholders, then we remain in the market. Otherwise, someday we have to join hands with another company and either merge with them or they acquire us, if we not able to compete. So, if we not able to compete with, then other company will sell us. Otherwise, it may be possible due to non profitability we can be bankrupt. Common reasons for mergers acquisition deals. First, access to a developed customer based and cash flow. First reason is to develop customer base and cash flow. New channels, geographical market. Okay. So, we have a customer in our country. Now, we need a customer, more customer from international from outside the international boundaries. So, we going outside, we move outside, we work and work in international market. But it is not so easy to work in an international market. We need to compete with international companies also. We have to produce a product or services according to the international client. We have to maintain the standard We need to maintain the standard accounting to the international client. So, therefore, the first approach, a first common reason of merger acquisition to maintain the flow of fund, second maintain the or increase the customer base. Point number 2, access to new technology and organization capabilities that can be leveraged to extend strategical opportunities. So, here the word is opportunity. As we do the strategic planning, all business do the strategic planning. So, when business do the strategic planning, they find out the threat, the opportunities, the weakness and their strength, commonly known as SWOT analysis, Okay. So, first find out the opportunities. If there is a opportunity, what is the requirement to grab that opportunity? What is the requirement to grab that opportunity? Now, if you have opportunity in any European market, what kind of technology you required? What kind of market you required? I take an example here. I take an example of India. As we know, India is a vast country having a huge population. Now, due to FDI relaxation, number of insurance company come forward and they want to work in India, they want to operate in India. For that, they need to join hand with Indian companies which have established market, Let us take example of ICICI Lombard. ICICI is Indian bank and Lombard is an insurance company of UK. Now, an insurance company need more and more clients. Indian company need more and more clients. So, they join together, and this is not an acquisition or merger, but it is an example of joint venture. But sometime foreign company come to India and acquire or merge with Indian company, which is happened with Idea and Vodafone. Initially, Vodafone acquire Hutch. You remember that word Hutch, okay? It is a famous telecom company. Vodafone acquire Hutch. Then when Vodafone acquire Hutch, it start give competition in India to Indian companies like Tata Docomo, Reliance, VSNL, Airtel, Idea. All are Indian except Vodafone. Now, to reduce the market, they join together, merge together to reduce the competition among them, to lose the customer, because customer have now rights to port their number from one operator to another operator. To maintain the customer, they join together. This is strategic opportunity. Sometimes due to new technology, companies are doing mergers and acquisitions. Consolidate a business unit or industry, increase revenue and share price. When there is a single business unit, it may possible that it increase the revenue, and when revenue increase it, it will increase the share prices. It will increase the share prices. So, it is one of the consideration while doing the merger or acquisition, when we are going to do mergers, or it is one of the basic concept to increase the revenue, and when revenue increased, when revenue increases, then the price of the share can be increased. Fourth point is to leverage the economic of scale or synergy that reduce the cost. Of course, if you work individually, if you produce individually, may be possible you are not working on optimum basis or economic of scale. When company not able to reach the economic of scale, its cost will high, its cost will high. I again take the example of here some Indian mergers, like merger of bank, like mergers of bank. Now bank merged together SBI, the RBI, Union Bank merged Vijaya Bank and Andhra Bank. Now due to merger, Punjab National Bank acquired the Oriental Bank of Commerce merged with PNB. So due to the merger, first the competition reduced among the banks. Now Union Bank having the client of Andhra and having the client of Vijaya also, and they are working on economic of scale. I am sorry, Vijaya Bank acquired by the Bank of Baroda, sorry, I am sorry. So here the office staff is same, office premises is same, client increases, there is no competition, for advertisement and etc. So it reduce the cost of banking sector. So these are the common reasons. Primary cause of failure are preoccupation by business leader on finance and systems issues at the expenses of vital intangible assets critical to merger process. These include human resource, business culture, company structure and corporate governance. Second is poor due diligence with failure to obtain intelligence on the corporate culture and human capital. Fifth is weak post merge integration strategies that put little emphasis on integrating senior management and workforce. These are the basic three things which are causes by the failure of mergers. Now, what is exchange ratio? Exchange ratio is a relative number of the new share in exchange of the existing share of the company which acquired by the mergers. After the old company share have been delivered, the ratio has been changed. So, इस एक्सचेंज एक कंपनी जब दूसरे कंपनी से मर्ज होती है तो उसके शेयर के बदले आपको कितने मिलते हैं? आपका 10 शेयर हैं और एक्सचेंज रेशियो है 1:10, तो अब 10 के बदले आपको दूसरे जिसने एक्वायर किया है उसका एक शेयर मिलेगा, दैट इज एक्सचेंज रेशियो. The exchange ratio calculate how many shares acquiring company need to issue for each share of investor owner in a target company to provide the same relative value of the investors. The target company purchased often including price premium acquired due to 100% control. Intrinsic value of the shares and the underlying value of the company considered to be coming with an exchange ratio. The two type of exchange ratio are, there are fixed exchange ratio and there is a floating exchange ratio. Example, Punjab Sindh Bank merged with Indian Bank, announced equity public sector banks merge, public sector bank merger. This is the example of public sector bank merger. I am sorry, public sector bank mergers. Indian Bank announced equity ratio of Allahabad Bank. Like so, Indian Bank of Thursday announced, it is a news of in Business Standard, a fair equity exchange ratio of 115 of 10 rupee each of 1000 of Allahabad Bank. So, Indian Bank acquire Allahabad Bank. The one, if you have 1000 share of Allahabad Bank, you will get 115 equities of rupees 10 for every 1000 shares of rupees 10 of Allahabad Bank as a part of amalgamation in the latter business. So, this is exchange ratio which was given in March 23, 2020. As per the RBI, the banks were merged, and it is a news of the as in Business Standard newspaper. So, this is the example of exchange ratio. So, my dear friends, these are some referencing books, and I also quote the Business Standard here. So, we get the news of banking mergers, because banking merger are the good example of mergers in India, because it reduced the competition among the bank sector. It reduced the competition among the various banking and sectors, where sometimes there are two banks merged with one bank. Hence, in today's class, we able to understand that what is concept of merger, what is concept of acquisition, why companies come forward for mergers, what are the reasons, what are the various reasons for the mergers, what are the various reasons for the merger, and finally, I give an example of public sector bank merger of in exchange rate concept, where exchange rate is a concept where when two companies merge, the shareholder get the benefit of the shares, and here 1000 share of, if you have a 1000 share of Allahabad Bank, then you get 115 share of Indian Bank. This is exchange rate. Thank you for watching this video. I hope you understand all this topic. Thank you.